The Trump administration is radically reshaping America and the world around it. In the inaugural Vantage Point essay from Australia Institute Press, Dr. Emma Shortis examines Trump's grim vision for America and the future of the Australia-US alliance. Pre-order your copy of After America, Australia and the New World Order, or become a Foundation subscriber to Vantage Point at australiainstitute.org.au/store or via the link in the show notes. Hello and welcome to Dollars and Cents, the Australia Institute podcast where we're talking about just what the hell is going on in the economy. I'm Elinor Johnston-Leek, the senior content producer here at the Australia Institute, and not as always because I was away last week, but today I'm talking to our chief economist, Greg Jericho. Hello, Greg.
Hi, Elinor, and welcome back from your massive trip.
Yeah.
Out to see the Mirajuga artworks.
Yeah, it was incredible, honestly. I mean, yeah, truly a treasure worth protecting.
And we're going to be seeing more of your trip and all the excellent reporting that was done by you and Stephen Long.
Yeah. Keep an eye on the socials.
To be announced
Yes.
later.
That'll be coming out soon, so keep an eye out for that. But Greg, how was everything while I was away?
Well, I was sick, so.
Oh, okay. Well,
Hayden was excellent, as always, stepping in and bringing his own unique perspective on things. I'd say that in a good way, Hayden. But I've also spent most of the week laid in bed with a bit of a something that I keep testing negative for, so I don't know what it is, but you can probably still detect in my voice a bit of a frog somewhere lodged at the back. But
stay away from me.
Yes, I will.
Okay. Well, Greg,
the economy.
Yes, on the economy, which still exists, unfortunately.
Greg, I think it is a little bit fortunate that we've got
all right.
Anarchy is just taking over the dollars and cents pot.
Greg, we've talked a lot about house prices recently on this pod, and something that our boss, the big head honcho, Richard Dennis, has said recently is the only way that people are going to be able to afford a house is if their wages actually rise faster than house prices.
This is not complicated. As long as house prices are rising faster than wages, you can't catch up. And I'm sorry, but it's a cruel hoax for people to tell you that a tax break here or something or other there is going to help.
And as we've talked about a lot, house prices have had a pretty big head start. It's kind of like if, it was Usain Bolt racing me, me being wages. But there's some new wage data out. How are we doing? Are wages rising?
Yes, and the good news, and look, let's try and be positive as we always are here on the Dollars and Cents Pod. We never have any negativity creep in here. Wages finally are rising faster than prices, faster than inflation, which is the absolute key for what we call real wage growth because the whole point of earning more is that hopefully you can buy more things with your wage.
Yep.
And that's basically the key of real wages growth.
So why we work.
Yeah. So what we saw in the last year on average was that wages grew by 3.4%.
What we're seeing today is now 18 months, 6 consecutive quarters of real wage growth in our economy in annual terms.
Now, obviously, that doesn't mean everyone's wage grew by 3.4%, but sort of on average, that's what's happened. And the ABS actually gives us some really kind of cool data in that they know in the private sector, about 15% of people in the private sector got a wage rise in the first 3 months of this year.
Okay.
And about 35 to 40% of public servants across the country got a wage rise.
Oh.
The growth in the first 3 months of this year kind of mostly came from the public sector, which might have you thinking, Peter Dutton was right. Those damn public servants, we need to cut them back. And no, it might surprise you that no, Peter Dutton was not right. Yes, there was a big increase in public sector wages. Most of it, though, was from state public servants and their enterprise agreements, which there were a number that were agreed. And so we saw a really big quite significant increases in wages for public servants in Tasmania, New South Wales and Western Australia. But when you actually look at what's happened to wages since, sort of over the past 3 to 4 years when inflation really started taking off, public servants have actually done it a lot tougher. They have really lagged behind workers in the private sector. It's mostly been private sector workers who have been getting bigger wage growth. So even though right now you might say, oh, yeah, public servants are getting better wages, it's kind of a bit of a catch-up rather than, they're just doing it easy. So it really isn't a case of, we should cut back on public servants. It's a case of, we're actually finally giving some public servants, especially in areas like healthcare.
Yeah, I haven't noticed there have been a lot of sort of healthcare strikes, and didn't all of New South Wales psychiatrists walk off the job at one point?
Yeah. And also what we see with these figures is a bit of a flow through of award wage increases, and we're not talking about quote unquote public servants who are always vilified and, it's, they're just sitting behind a desk. We have to remember that frontline workers, as we know, are public servants, and mostly that's what we're talking about here, especially given it's sort of state-based rather than, the national public service. But even there, very clear that public sector workers have really struggled to get a good wage increase during this period where prices have been rising strongly, but at least now they're getting some sort of catch up.
Well, that's good. And, while that is good, what does this actually mean for cost of living at the moment?
Yeah, this is a really crucial point because as a general rule, when economists talk about real wages, they compare wage growth with the consumer price index, inflation, because inflation is notionally prices. So you think, okay, if your wage goes up by 3.4% and inflation went up by 2.4%, which is what happened over the past year, oh, great, my real wage went up by 1%.
Yeah, you can afford
minus 2.
Slightly more, yeah.
Yeah, but the thing is, the consumer price index doesn't count one very important thing, and that is mortgage repayments.
Every time you say that, it still shocks me that that's not included. I mean,
it's not. It used to be included. It used to be included. Then in the mid to late 90s, they decided to take it out.
Why did they decide to take it out?
Notionally because when the Reserve Bank raises interest rates, it's doing so to reduce inflation.
Yeah.
And so by raising interest rates, it was helping raise a thing that was raising,
This feels like some economist tinkering.
Yeah, I'm inclined to agree, which is why we, and as listeners will know, we don't just have the consumer price index. The Bureau of Stats also puts out these things called cost of living indexes, which are broken down into different household groups. And the main four are employer household groups, so where someone in the household has a job. Then you have age pensioners. Then you have quote unquote self-funded retirees, or as we say here, taxpayer-funded retirees.
Yep. Sure.
And then there's also other government benefit households, which people on disability support, job seeker,
etc.
Yeah, etc. But mainly those two, and I guess also single parenting payment, but mostly job seeker and disability support pension. So they split them up into 4 different groups, and the reason they do that is because we know that different household types have different spending habits. Pensioners spend more on certain things than, say, households that have workers in there. For example, a key thing is education, because age pensioners are not spending much on education or childcare, whereas employee households generally are, because, if you're working, you've probably got a family as well. And another key thing about these cost of living indexes is they take out one thing that is in the CPI, and that is the cost of building a new home, because they're kind of like, is that really a cost of living index?
Yeah.
Is that a cost of living? No, that's a choice you've made.
Yeah.
Yes, we might want to measure that cost to look at overall prices, but it's not really cost of living. So they take that out, and what they put in is the cost of repaying a mortgage.
Sounds sensible to me.
Yeah, and remember that the cost of repaying a mortgage since sort of March 2022 has kind of gone up by around the order of 165%. So this has a big impact on cost of living compared to inflation.
Yep.
And so we've got one measure, CPI, official inflation, that doesn't count interest rates and mortgage repayments.
Yep. One of the biggest things that people spend their money on. Yep.
That's 2.4%.
Yeah.
The employee cost of living index, which does include mortgage repayments, over the past year, that rose by 3.4%.
Right.
So 1% different. Now, why is that key? Is if you're a wage earner, you are obviously employed. So it might be best to actually compare your wage with your actual cost of living rather than inflation. And of course, when you do that, it's like, oh, actually my wage went up by 3.4%, my cost of living went up by 3.4%. Oh, my real wage didn't go up at all.
Okay.
So that's a real key issue. It's important when we're talking about, things are getting better. Yes, if we're looking just at inflation, but if we're looking at overall cost of living, there's still a long way to go, still a struggle. And even if we're really sort of kind and we just look at inflation, you're still earning about 4.4% less than you were back in March 2021, which you think, okay, so in the past 4 years, I've lost 4.4% of my wage. What does that mean? Well, the average full-time wage back then was around sort of $90,000. That means you've lost about $4,000 worth of purchasing power. In effect, you're able to buy $4,000 less stuff than you could 4 years ago. Now, if you include mortgage repayments, it's probably around $8,000 less. Now,
sick.
So if you don't have a mortgage, hooray! You're not so much, but it just shows that this is, and the good news is this isn't as bad as it was a year ago when it was closer to $4,500 behind. We have started improving. But it also means that there is a long way to go to get us back just to where we were 4 years ago. How long?
Well,
probably like if we keep improving at the pace we have over the past year, we'll get back to where we were in March 2021, right around the end of 2031.
Okay. And is that if mortgages don't skyrocket?
That's the one if we just look at CPI. With mortgages, it's probably around the same, yes, because there kind of are swings and roundabouts. It's just that right at this past 3 years, it's been really bad for mortgage holders. If you go back to before the pandemic, mortgage holders were kind of doing okay because interest rates were coming down. That meant employee cost of living was actually lower than inflation because, you're taking my mortgage into account, my mortgage repayments are going down. So it's good. But
Okay, so that's wages. So how are house prices doing at the moment? Are they still sort of skyrocketing?
To
the moon?
Is the thing again. We've said, okay, let's compare wages to inflation. That 2.4%. Okay, let's compare it to cost of living, 3.4%. Okay, so that's about equal. How are they going compared to things like the cost of taking out a mortgage, like the average size of a mortgage? Well, this week as well, we got the latest, what we call lending indicators, which is basically all the new loans that have been taken out by investors, by homeowners and so forth. And over the past year, wages went up 3.4%. The average size of a mortgage across Australia went up 8.4%.
Oh, God.
Sorry.
For the listeners, I just sort of slapped my hand to my forehead.
Yes, there was big slapping of forehead.
Yes.
So it's because it all boils down to, again, when we're talking about how do we get real wages going up, well, your wage needs to go faster than price. If we want housing affordability to go down or to improve, wages and your income needs to go up faster than house prices. And clearly that ain't happening. If the cost of taking out a mortgage, if the size of that mortgage is going up faster than your wage, then
significantly
faster, and you extrapolate that through to the size of the deposit that you need, Not a good situation.
No.
And again, I've been sort of saying, let's look over the past 4 years, which is sort of since March 2021 when inflation started taking off. What's the situation there? Again, your wage has gone up around 14 and a bit percent. The size of mortgages has gone up 30%. But that's the national figure, which includes Melbourne and the ACT, which haven't been too bad.
Mm.
So if you live in, say, South Australia, over the past 4 years, wages on average have gone up 13.8%. So kind of cool.
Yeah.
The average cost of a mortgage in that time has gone up 53.5%.
Oh, gosh.
Shout
out to South Australian listeners.
So and this is something which certainly our listeners in Adelaide would know, is that, before the pandemic especially, Adelaide was routinely sort of looked at as, that's a place where housing is pretty affordable. It's, especially better than Melbourne or Sydney.
Yep.
And okay, it's not like Sydney, nothing's like Sydney. But over the past 4 years, the cost of buying a house in Adelaide has risen so fast that it's kind of now on a par with Melbourne and Brisbane and Perth. It's not anymore the cheap place to go and live. It really just highlights, this is not it's just a Sydney problem. It is a nationwide problem. And Hobart had the big surge before the pandemic. Other places, especially Adelaide, Brisbane and Perth, the past 4 years have just been horrendous for you wanting to buy a house, because you're thinking, right, I'm doing well, I'm saving up for my deposit, and then basically the cost of that deposit has just exploded, and your wages have not.
We've got real wages growth as a deliberate design feature of our economic plan as a Labor government.
Well, real wages growing means that it will help support consumer spending growth and overall economic activity.
Our objective here is a more dynamic and a more inclusive labour market as part of a more dynamic and more inclusive economy.
Yeah. So it's a nationwide problem. We've got a new federal government. What can the Albanese 2.0 government do about this? What can we do? First off, what can they do to support wage rises?
Look, this is one area which actually the government at least has a good foundation to build off of, because industrial relations was actually one of their key kind of bold, brave policy areas of the first term, with Tony Burke as Minister for Employment. So they had a employment white paper, which they haven't done a lot of the recommendations, but they did make some really significant changes to industrial relations that essentially made it easier and more able for workers to be able to bargain for higher wages.
That's good.
A key one was allowing low-income workers, especially in hospitality, who notoriously are very low unionised because you're working in like a cafe, a restaurant. If you had a shop steward meeting, there'd be 2 kitchen hands. It's not a case where you're really going to get any strong unionisation. But what they've done is allowed sort of multi-employer bargaining to occur so that you can actually get a real group of workers doing the same type of job, like being a wait staff or kitchen hands or things like that, to be able to bargain with employers for better wages. That's crucial. They've also been quite good on care work and supporting increases in wages there.
That's good.
And also even just for minimum wage and award wage rises, they've been quite positive in at least calling for wage growth at least at the level of inflation, if not a bit higher. So they can continue to ensure that those conditions remain in place, because let me tell you, the employers don't like them. They don't like things like same job, same pay legislation, which meant even if you get a labour hire firm to get someone, so if you've got 2 people working in a mine, for example, doing the same job, they're getting the same pay.
Seems sensible to me. Yeah.
All of these things which help engender a situation where workers are actually able to bargain for wages. So that's crucial. But as we know, that ain't going to do much for house prices.
No. Which, I mean, we've talked a lot about what we can do for house prices, but maybe just a quick recap.
Well, one thing, and this is we are doing some. Our colleague Matt Grudenoff is doing some research that will be a bit of a spoiler. Is coming out next week. One of the things that government can do, and this is working with the organisation known as APRA, the Australian Prudential Regulation Authority. Basically, the body that takes care and regulates banks and lenders, is putting this thing. And here's a wonderful term that is a great bumper sticker: macro-prudential tools. Macro-prudential tools.
Okay.
Because what we know is that next week, and this is probably something we'll be talking about next week, interest rates are probably going to get cut, because next Monday and Tuesday, the Reserve Bank Monetary Policy Board are meeting. Investors are pretty sure there's at least going to be a 25 basis point cut.
Yeah.
So what happens, though, when we cut interest rates?
People buy more houses.
Yeah. People can borrow more. So generally, house prices go up.
Yeah. Great.
But one of the big drivers of that is not people wanting to buy a home, it's investors. Because investors are like, oh, the cost of borrowing is going down. That means my return on my investment, I don't need as much to make a profit, so let's go for it. And we know that investor borrowing is what can really add heat to house prices. So what happened in 2016, 2017, around that time, when we were also seeing investor loanings go mad, is APRA instituted these things which forced banks to limit how much they could borrow to investors. And that significantly dropped the amount of investors in the housing market and actually kept house prices from really going mad for a good period.
Okay.
And so we recommend that that's something that should be done now, because we're certainly going to be seeing interest rates falling. The market's predicting maybe 3 cuts by the end of the year. They were predicting 4 or 5, but now Donald Trump doesn't seem to be as insane. Well, relatively.
Yeah.
But it's still, what you want to do is to be able to lower interest rates but not cause house prices to explode, because you want lower interest rates because that helps small businesses for their small business loans. They go down. You want lower interest rates so mortgage holders have their cost of living goes down so they can spend more, and that buoys the economy. But what you don't want is to then also set fire to house prices, which makes housing affordability go even more in the toilet. So if you bring in rules that actually limit investor borrowing and keep sort of investor interest rates higher, while home lenders, or what we call owner-occupier lenders, their interest rates fall, that kind of helps rebalance things. So that's certainly something that the government could, in effect, instruct APRA to say, hey, we don't want you just to worry about financial stability, but we also want you to do these things for reasons of housing affordability and to be mindful of that. So that's something that they could do. Obviously, all those other things, get rid of capital gains tax, build more houses and all that. But
etc.
There are things that they can do right now that at least
great.
will, they're not going to make everything fantastic, but what it does is at least prevents or at least dampens any sort of explosion that's going to likely come from, we know the Reserve Bank's cutting interest rates, so let's all go shopping,
Well, fingers crossed, because I don't know how much more explosions in house prices we can do.
Well, I mean, we, as I say, we think 3.4% wage growth. Oh, great, it's good. And then 8.8% mortgage.
50% was it in Adelaide, South Australia?
Yeah, I mean, that's over 4 years, but still. What was it, 54% compared to 13% wage growth? That is not an equation that adds up to better housing affordability. And, until we have policies in place that acknowledge that and say we don't want that to keep going, we're going to keep going.
The US and China have agreed to significantly decrease tariffs on goods being sold between the two economies.
Yesterday, we achieved a total reset with China after productive talks in Geneva.
The consensus from both delegations this weekend is neither side wants a decoupling.
The relationship is very good. We're not looking to hurt China. China is being hurt very badly.
Well, we are running out of time, but we probably have time for just a very, very quick tariffs corner right at the end. I haven't really been paying attention to the news to the tariff news because what's the point? When I have you to tell me about it. What's happening?
Yeah, Donald Trump blinked, as he always does. Donald Trump does two things. He announces victory, and then when everyone looks at the announcement, they were like, oh, you blinked.
Yeah.
So basically what happened, China and America sat down in Geneva, had some negotiations, and America gave China everything that they wanted. Now, the markets were excited because they're like, oh, everything's good now. It's actually still worse than it was before Trump went mad, but we've gone from having those 150% tariffs. Now they're back to 10% and 30%. Basically, America gave up nothing or got nothing in return for giving up everything. And it's still a 90-day kind of pause of we'll go back to this rate for 90 days. But if you're going to pause, it's like you're obviously admitting that you're getting screwed by these tariffs yourself. Nothing was being shipped into America from China.
Yep.
Stores were going to have empty shelves, and Donald Trump was like, oh, tariffs suddenly not my most favorite word in the world. And so a lot of blinking there. So everyone, including people in Australia, like, well, maybe it's not going to be as bad as possible as we thought. Problem is, who the hell knows?
Yeah.
I mean, I was giving an interview on ABC Radio talking about tariffs, going, doesn't seem like anything has been announced, and within 2 hours they announced something. You know?
Yep.
And so you have no idea, and investors don't have any idea, companies have no idea, and that's kind of still freaking everyone out. So not as bad, but still pretty bad.
All right, well, maybe we'll have more updates for next Tariffs Corner. I reckon that's all we've got time for today, Greg. Thanks so much.
I think it is, and really good to have you back, Elinor.
Thank you.
No, it wasn't a positive chat at all. It started off good and went off a cliff very quickly. Oh, well, these things happen. But next week, we will be back for another Dollars and Cents, and I'm pretty sure we're going to be talking interest rates, whether they're cut or not. And if they're not cut, I'm coming off the long run.
Yeah,
I'm coming
that will
in
be
hot.
a spicy
so
one.
tune in for that one. This episode of Dollars and Cents was recorded on Thursday, the 15th of May, and some things may have changed. Hopefully, my voice will change and I won't be as croaky by this time next week. If you want to see all the graphs about wage growth and cost of living and the increase in mortgage sizes, have a read my column on the Guardian Australia website. And for more research on cost of living, on house prices, Matt Grudenoff's research, which will be out, we think, this time next week, will definitely be there. Please go and have a look at our website at australiainstitute.org.au. There is a mass of stuff there. Our music, as always, is by Blue Dot Sessions. Everyone, have a great week. We will see you again next week.
See ya.